The flow just reversed. For months, institutions were sitting on gold. Safe, predictable, the textbook hedge. Then something shifted, quietly, without headlines, without announcements. Banks started selling gold and rotating into silver at prices most retail traders think are already too high. $88 silver, and they're buying. Not nibbling, not testing. Buying size. The kind of size that shows up in vault transfers, not Twitter polls. The kind of size that doesn't care about your support and resistance lines because they're playing a different game with a different clock. Welcome back. This is the breakdown on the institutional rotation everyone will talk about in 6 months, but nobody is paying attention to right now, because when banks move, they don't move for entertainment. They move because the math changed. And when the math changes for them, it's about to change for everyone else. Quick favor, subscribe. Short and simple, because this rotation has stages. And if you're not tracking each stage in real time, you'll wake up 3 months from now wondering how you missed it. Now let's get direct. Fact. Multiple vault facilities have reported unusually high gold withdrawals paired with simultaneous silver deposits in recent weeks. Fact. Gold to silver ratio has been compressing aggressively, moving from above 90 to under 80 in a matter of weeks. Fact. Institutional silver positions via ETFs and futures have been building even as price climbed into the upper 80s. Interpretation. The smart money is rotating, and they're doing it before retail even understands why. Here's what most people miss. Banks don't rotate because they love silver. They rotate because risk-reward shifted. They ran the numbers. They looked at inventories. They looked at supply chains. They looked at industrial demand curves. And they made a decision that terrifies anyone still overweight gold expecting safety. Because here's the uncomfortable truth. Gold is crowded. Everyone owns it. Central banks bought it. Retail stacked it. Hedge funds allocated to it. Gold became consensus. And consensus is the most dangerous position in markets. Silver? Silver was the forgotten metal, the industrial afterthought, the thing people bought after they finished buying gold, until institutions started doing the math on deficits, refining bottlenecks, and what happens when solar, EVs, and data centers all need the same input at the same time. That's when the rotation started, not because silver is sexier, because silver is scarcer where it matters. Here's the first lesson. When institutions rotate, they don't announce it. They just do it. And by the time you see the headlines, they're already positioned. Now let's talk about why $88 matters. To retail, $88 looks expensive. It looks like you missed it. It looks like the top. But to a bank running supply models, $88 looks like a gift. Because if silver has to reprice to match the physical reality, industrial scarcity, and geopolitical fractures in the supply chain, $88 is the entry, not the exit. Think about it. Gold at $4,000, silver at $88. That's a ratio still above 45 to 1. Historically, that ratio trades closer to 60 or even tighter during stress. If silver just normalizes the ratio, you're looking at $130 to $150 without needing a single new fundamental, just mean reversion. But here's where it gets better. Mean reversion assumes static conditions. We're not in static conditions. We're in a deficit market with Chinese export restrictions, London vault stress, and industrial buyers bidding over spot for immediate delivery. So when banks rotate at $88, they're not betting on ratio compression. They're betting on a repricing event that makes ratio compression look like noise. Let's get concrete. A bank doesn't sell gold to buy silver unless the risk profile justifies it. Gold is liquid. Gold is stable. Gold is the ultimate collateral. Selling gold to rotate into a smaller, more volatile market means they've decided the upside in silver outweighs the safety of gold. That's a massive signal, because banks are conservative. They don't chase memes. They don't YOLO into Reddit threads. They position when the data supports asymmetric returns. And right now, the data is screaming silver. Here's the second lesson. When the cautious money starts rotating, the aggressive money is already there. And retail is still debating whether it's too late. Now let's talk about the mechanics of the rotation, because this is where it gets dangerous for anyone holding the wrong side. When banks sell gold, it doesn't tank the gold market immediately. Gold is huge, liquid, deep. A few billion in selling gets absorbed, but it creates drag. It caps upside. It makes gold feel heavy. Meanwhile, silver is small, thin. A few billion in buying doesn't get absorbed. It gets amplified. Every incremental bid pushes price harder because there's less inventory to satisfy demand. So the rotation creates a feedback loop. Gold underperforms, silver outperforms. That performance gap attracts more capital. More capital widens the gap. And suddenly everyone who was safe in gold starts asking the question they didn't want to ask. Am I in the wrong metal? That's when the rotation accelerates. That's when it stops being institutional and becomes mainstream. And that's when price discovery breaks, because the crowd is trying to move through a door that's too narrow. Here's the third lesson. Rotations don't happen in straight lines. They happen in waves. And the first wave is always the institutions front-running the second wave. Now let's address the fear most gold holders have right now. If silver is the play, does that mean gold is done? No. It means gold is mature. Gold already ran. Gold already got the safety bid. Gold is sitting at all-time highs with central banks still buying, but retail starting to wonder if the upside is capped. Silver, on the other hand, is just breaking out of a multi-year base. It's nowhere near its inflation-adjusted highs from 1980 or even 2011. It has room. And more importantly, it has urgency. Industrial users can't wait. They need metal now. That urgency doesn't exist in gold. So the rotation isn't bearish gold, it's just more bullish silver. And in a world where capital is finite, more bullish silver means capital has to come from somewhere. That somewhere is gold. Let's look at the signals that confirm the rotation is real. Signal 1. Gold ETF outflows accelerating while silver ETF inflows build. Signal 2. Vault transfers showing gold leaving and silver entering the same facilities. Signal 3. The gold-silver ratio compressing despite both metals being in bull markets. When all three signals align, it's not noise, it's a trend. And trends driven by institutional repositioning don't reverse on a tweet. They reverse when the fundamentals that cause the rotation change. And right now, those fundamentals are getting tighter, not looser. Here's the fourth lesson. Institutional flows are slow, then fast. They accumulate quietly, then the acceleration happens all at once. If you wait for confirmation, you've already missed the move. Now let's talk about what this means for the next 90 days. If the rotation is real, and the evidence says it is, then silver has to reprice higher to reflect the new demand base. $88 was the entry for institutions. $100 becomes the psychological breakout for retail. And once retail starts chasing, the institutions that rotated early start scaling out into strength. That's the playbook. Rotate early, let retail chase, take profits into the mania, then reload after the correction. It's the same cycle every time. The only question is where you are in the cycle. And right now, if you're still sitting in gold waiting for safety, you're early cycle thinking in a late cycle market. The institution's already moved. The question is whether you're going to move before retail or after. Now here's the part that makes this rotation even more dangerous for gold. If silver starts outperforming aggressively, it creates a narrative problem for gold. The narrative has been gold is the safe haven. But if silver is delivering better returns with industrial demand backing it, the safe haven story starts to crack. And once that story cracks, gold doesn't collapse. It just stops working as well. It becomes dead money. And dead money in a bull market is the worst position because you're holding something that's not falling, but you're watching everything else run without you. Let's get practical. What should you watch to confirm this rotation continues? Watch the ratio. If gold-silver compresses below 40, the rotation is in full force. Watch institutional filings, ETF holdings, 13F reports, anything that shows large players increasing silver exposure. Watch vault activity. If major storage facilities keep reporting gold out, silver in. The rotation is structural, not tactical. And watch price action. If silver holds $85 as support after testing it, institutions are defending their entries. That's the tell that they're committed, not just trading. Here's the fifth lesson. Confirmation is expensive. By the time everyone agrees the rotation is real, the easy money is gone. Now, I'm going to ask you two questions. Answer in the comments. 1. If you had to hold only one metal for the next 12 months, gold or silver, which would it be and why? 2. At what price does silver become too expensive for you to add? Or is there no price because you're focused on ounces, not dollars? Your answers will show me whether you're thinking like retail or thinking like the institutions. Now let's address the counter-argument because we don't do propaganda here. The counter-argument says banks aren't rotating, they're diversifying. They're adding silver without selling gold. The rotation narrative is overblown, and that's possible. But here's what the data shows. Gold holdings at major ETFs have been flat to declining. Silver holdings have been building. Vault utilization for gold is steady. Vault utilization for silver is tightening. The flow is directional, not balanced. So either institutions are adding silver with fresh capital, which is bullish, or they're funding it by reducing gold, which is also bullish for silver. Either way, silver is the beneficiary. And here's the kicker. Even if some institutions are holding both, the marginal buyer sets the price. If the marginal buyer is rotating from gold to silver, silver outperforms. That's not theory. That's market mechanics. Let's talk about what kills the rotation. The rotation dies if one of three things happens. 1. Silver supply surges unexpectedly. Not happening. Mines don't turn on overnight. 2. Industrial demand collapses. Not happening. Solar, EVs, and data centers are structural, not cyclical. 3. Gold breaks out to new highs and reasserts dominance. Possible, but less likely if institutions are already rotating. So the risk to the rotation thesis is low. The risk to being late to the rotation is high. Here's the sixth lesson. In a bull market, the bigger mistake is missing the move, not buying too early. Now, here's what happens when retail figures this out. Right now, retail is still debating, still watching, still waiting for a pullback. But once the rotation narrative goes mainstream, once financial media starts running segments on the great gold to silver shift, retail floods in. And when retail floods in, two things happen. One, silver spikes violently because the market can't absorb sudden retail demand. Two, institutions start scaling out because they know retail is the exit liquidity. That's the setup. Institutions rotate now at $88. Retail chases later at $120. Institutions sell to retail at $140. Then the correction comes and retail holds the bag while institutions reload lower. Don't be retail. Here's the summary. Banks are rotating from gold to silver at $88, funding the move by liquidating gold positions. The gold-silver ratio is compressing, signaling institutional preference shift. Vault data confirms gold out, silver in. Industrial demand and supply deficits justify the rotation mathematically, and the move is happening before mainstream awareness, which means early positioning still has edge. If you want the next stage of this rotation tracked in real time, subscribe now, because rotations have multiple phases, and each phase has different risk-reward. You need to know which phase you're in. Last thing, the biggest mistake you can make is thinking this is about picking a team, gold versus silver. It's not. It's about reading the flow and positioning where the capital is moving, not where it's been. And right now the capital is moving from the crowded trade to the scarce trade, from the safe trade to the asymmetric trade, from gold to silver. One final clue. If you see gold start to consolidate while silver keeps grinding higher, that's the rotation in real time. The institutions aren't waiting for permission. They're just moving, and the market will confirm their decision months after they've already positioned. Now watch the ratio, because the ratio is the scoreboard. And when the scoreboard starts flipping fast, everyone will claim they saw it coming. But the truth is, most people are still holding gold wondering why it stopped working. Don't be most people.